Hi, in this episode of Neppy Invest, I'll be looking at catching falling knives, which I probably don't recommend in real life or in your investing life, and breakouts. So they are related. So I always look for companies where I see a rapid decrease in share price, which is catching a falling knife. And I put those companies on a watch list and I just wait for those companies to see if they go through a potential breakout. So I'm going to show you a few examples of catching falling knife situations and breakouts. So looking for, I'll be focusing on three companies, and those companies are AGL, Treasury Wine Estates, and Costa Group. So one of these companies I do own for disclosure purposes, another company I owned for like 3 days before I sold out, and another company I've just put onto my watch list a few weeks ago, and just watching that to see if it goes through a breakout situation. So let's get into it. What is catching a falling knife? I've sort of already hinted at what it is. It's just a rapid decrease in the share price of a company. And we can see here with Treasury Wine Estates, we had a catching falling knife or falling knife situation back in January of this year. We can see share price went from about $17 all the way down to $12 or $13. And usually when you see that sort of situation, there's some sort of catalyst behind it. And I'll get into the reason why in a second or so. But the psychology behind this and why I'm talking about this is a lot of people, and why falling knives or catching a falling knife is relevant. And you might hear the saying a lot, don't catch a falling knife. And why it's relevant based off psychology is what's referred to as recency bias. So when the people see the share price, say $13 or so on this day, they think, oh, a few days ago, the share price was $17, $18. It must be cheaper. I'm going to buy in right now. And I think that's bad logic, because there is a reason behind the rapid decrease in share price. And typically in these sort of situations, we can see the share price decrease by quite a bit more. And usually the decrease in share price is based off bad news. And unfortunately, bad news can happen in, they say bad news comes in threes. And this is definitely the situation where bad news came in threes. So with Treasury Wine Estates, we saw the share price get down to 13. It just drifted downwards over the next few months, and then started to drift upwards. I look a little bit excited with Treasury Wine Estates back in July, start of August. And then they had, you can see there, if you go to August, a big increase in share price. That was based off full year results or half year results, or results in August. I'm not sure which one it is. And based off that, I actually did do a buy, but then a few days later, we saw another catalyst, another falling knife situation, and I rapidly sold out, and the share price just drifted down. And then yesterday, the 5th of November, from this, when I'm doing this video, we saw another trade or falling knife situation where the share price went down a lot. Now, I just had a look at the share price as it finished today on the 6th of November, and it did increase by 10%, but I'll get into that in a second. So there's always catalysts of falling knife situations or rapid decreases in share price. And it's always going to be bad news. You're never going to see a falling knife situation on good news. And I've just listed the 3 falling knife situations for Treasury Wine and what caused those 3 falling knife situations. So the first one was the big one. That was the one where we saw share price decrease 26%. It was based off revised full year or financial year 20 guidance. And whenever you see a downgrade, so there was a downgrade, whenever you see a downgrade, that's always going to be bad news. You never see share price increase on bad news, that sort of bad news. And I have this little problem with management groups, and it's based off guidance. And I sincerely believe that management should be much more conservative with their guidance, because when they give out guidance, sometimes I don't think they take into account worst case scenarios. They just think this business is heading in this direction, it'll continue heading in this direction, and there's going to be no barriers on the way to getting towards our guidance. And always seems to be some sort of barrier. Something happens which they didn't realize might happen, and they sometimes always overestimate their guidance or results. So I think management should be a little bit more conservative with issuing guidance. Be on the low side, be cautious, because the market always reacts very positive when you do upgrades. And if you're a little bit more cautious, then those chances of upgrades actually increases, and the market will adjust to that quite readily. I mean, seeing this situation, a downgrade in results saw share price decrease 26%. So market hates downgrades. It just hates it, hates it, hates it. Now, I can sort of blame management for that. Maybe their expectation was a little bit too higher than they should have been. But the second falling knife situation was not really under management's control. So they came out with results, for the financial year results, or half-year results, I don't know which one, on the 13th of August. And a few days later, the Chinese Ministry of Commerce initiated anti-dumping investigations into Australian wine exports. So they believed Australian winemakers were dumping their products into China. So this was just a bully tactic from China, trying to show how powerful they are to Australians or Australia. And this is something they've been going through for about 4 or 5 months, trying to bully their way, showing how powerful they are. So this is just what China's doing at the moment. And the share price reacted quite negatively to that, of course, because China is a fairly large market for Treasury Wine estates. In fact, if you go back to about a year ago, a lot of analysis were quite bullish on Treasury Wine because of the growing market in China, the growing middle class. That middle class are going to become more and more wine consumers as we move forward, and they're expecting the market to increase quite substantially in China for Treasury Wine. So if that sort of market is disrupted, that's why we see this rapid decrease in share price with this investigation. And then the final falling knife situation just occurred with the JGM and a Q1 trading update, in the share price, as I got there, fell 8%. But as I mentioned before, the share price did rebound quite quickly today. It was up 10% on the 6th of November. So this is a situation where we had that first falling knife situation. I was waiting for a bit of a rebound. It was on my watch list. It looked quite positive from late May into early August. The share price looked like it was trying to start a bit of a base, bit of an uptrend, and then we saw that breakout buy based off their results. And I actually did buy. That can be quite a bullish sign. It was on high volume. Then a few days later, we had the large down day on big volume, that investigation into Australian winemakers dumping their products into China. And for me, that is a sell strategy. Part of my sell strategy is whenever I see that big down day on big volume, I always sell. I don't hesitate. I don't think twice. It's a strategy of mine. Sell and just wait, be patient. I can always buy back in later. Some investors are very hesitant to buy back in once they've sold because it just sort of, they think, oh, I made a mistake and I shouldn't buy, or they become biased against a company. I see that bias a lot. When someone sells out of a company, that bias just infests in investors' mind, or some investors' mind. You can see it in hot copper a lot. When someone sells out, they just remain posting about that company, telling everyone how bad it is. Just let it go. That's all I've got to say about those people. So since that big down day, it's remaining on my watch list. So I'm waiting for another breakout and just remain patient. The share price rebounded quite highly today, but it's still below the trading moving average, the 20-day moving average. So I think today's large rebound was just buyers buying in because of recency bias situations, and they could be just seeing it cheap. It's $8, it's cheap. Or it could maybe just be some traders buying in, short-term traders. So AGL. So this is a company, energy company. In fact, I am a user of AGL. Anyway, so a user, but I'm not really interested in their share price a few years ago, but I'm becoming more and more interested because the share price keeps dropping. But just because the share price drops doesn't mean you should buy. Just look at AMP, for example. Even Telstra or something like that. Telstra a few years ago was like $5 or $6. Now it's $2.50 or something. Anyway, so start of this year, January, February, the share price got to as high as $21. I believe it was upwards of $24 in 2018 or 17. And then won't blame management for COVID-19. Share price dropped to about $15 or so, and then rebounded quite well, but still no sign of any uptrends. And then we had a falling knife situation in August. So all three examples I'm going to show you today either had a falling knife situation in August or a breakout in August based off financial results. So you're going to see a lot of these falling knives or breakouts happen during financial results season in August and in February. That's one of the reasons I really like those 2 months, is you see a lot of companies you can buy on breakouts, or a lot of companies that have gone into a falling knife situation, rapid decrease in share price. So we saw the rapid decrease in share price based off their results and outlook. The outlook was the big thing. So investors, a lot of investors look at outlooks, and the outlook for AGL was very, very bearish from management. So we saw a large decrease in share price, and then the share price just drifted for a little bit, but it's been going through a definite downtrend since then. If you want to argue with me that AGL is not in a downtrend, leave a comment, because I would like to see some sort of argument how you could justify AGL not being in a downtrend line. This is a very well-defined downtrend. It's actually in a downtrend channel, which I'll show you in a second. So there's always catalysts for falling knives, and this was their catalyst. So it was results for financial year 20 and some earnings guidance. So the results came in at 1,816 million, which was down 22% from the previous year, and then their guidance was 560 to 660 million, which is a significant decrease on financial year 20. So we've seen 3 years of significant decreases in profits, and market went down. Not only did it go down 9.5% on the day of release of these announcements and guidance, it's just been drifting downwards. And I think what's been happening with this drift downwards is fund managers can take a while to digest results, and a lot of fund managers who have been holding AGL looked at it and went, oh, this is not a good buy at the moment. Another thing actually they did was also say they're going to give 100% payout of their profits or cash flow into dividends, and that's always a trigger or bad sign for me that they're not thinking about growth or anything. If you give 100% of your profits, how can you grow? So this is the downtrend. So without a doubt, a trading channel. So it's within a trading channel since the falling knife situation, and I'm going to wait until this trading channel is broken, hopefully to the upside for AGL shareholders. And my hope is once it breaks out of this trading channel, it starts to trade sideways, consolidates in share price for a while, and then maybe in a year, I can't probably give a good timetable, year, 2 years, could be never, we finally see the consolidation period, the share price breaks out on the upside of that, and we start to see a new uptrend develop, and that would be the time to buy. Right now is not the time to buy, because this trading channel could continue for a long time. We could see a consolidation period happen for a long time. You could be holding this for a loss for a long time if you don't sell. So in these sort of situations, always be patient. So when I'm referring to being patient, I'm referring to myself. This is my strategy. So you can follow my strategies or not. It's up to you. You should develop your own strategies, what you're comfortable with, because I'm a little bit more risk adverse or risk taking. You might be more risk averse. So I think it's very important you develop your own strategies, but these strategies are my own. Whether you like them or not, it's up to you. Now we're going to get to Costa Group. So this is a company that I have bought into. So I do have a position in Costa Group. So this chart is not the current chart. So it's going from middle of 2018 to October 2018. So almost a year from the middle of 2018 to the middle of 2019. The reason I'm showing you this is Costa Group had 3 significant downgrades during 2019, and we saw share price go from a high of $8 in August 2018 to a low of about $2.50 in October or late September 2019. So there's a saying that downgrades always comes in threes. I wouldn't say always, but you can see it happen a lot where we have one downgrade and then we have further downgrades going forward. And we can see the first falling knife situation, a massive downgrade there. Share price went from $6.75 or something all the way to just above $4. So massive decrease in share price. We saw a really good rebound in share price just after that, and recency bias took effect at this point. So a lot of long-term investors saw the share price at, say, $4.50 and went, ooh, share price was only $6.75 a few weeks ago. Oh, this is cheap, I'm going to buy in. So they bought in. Share price rebounded quite well, but then it started to drift sideways, and then we had the second falling knife situation. The rebound in share price wasn't as distinct as the first one, just because I think there was a lot more skepticism. And then we saw the last falling off situation in late September, where the share price dropped to all the way down to, say, $2.50, which was almost the low, I think. So right here we do have that last falling off situation. Share price fell below $2.50 in late last year into start of this year, and that was the bottom. It's very hard to time the bottoms. It's almost impossible, because you want to see some sort of consolidation begin. I mentioned before, with AG, I'm going to wait for some sort of consolidation before I start to even think about buying, and this is a perfect example of this. We saw the share price consolidate from about February all the way through to August. So a fair while period of consolidation. The share price has traded between a range. So you can see those moving averages come together. That's when you can figure out its moving average, or you can just see the share price just trading from, there's not much range between the share price. And what I do in that sort of situation is wait for some sign of a breakout. And breakouts can happen a few ways. It can just be a share price breakout based off good financial news, which happened with Costa Group, or financial news and bullish expectations. So those are things I wait for. Consolidation or forming a base period can, go to the downside. I've seen that before too, where the share price can, after a period of consolidation, drop away. So with Costa Group, it was a breakout on the high side on large volume. So what I wait for is a breakout, which what happened here, based off, I'll show you the catalyst for this in a second. It was based off outlooks and good financial updates, and it was based off large volume. So I took a position on this day, decided not to be patient. It was exactly something I'm looking for, and we've seen the share price just drift upwards since then. So this is the reason behind the breakout in Costa Group. It was just good news all around. So the reason for the downgrades in the past were based off drought conditions in Australia, fungi, that sort of thing, things eating their fruit and veggies. They are international companies, so they do have operations in Morocco and China, and then international segments were performing strongly. You can see market conditions showing sizable improvement, driving increased earnings. So management quite bullish with their outlook, and quite different than the previous outlooks, where they're quite bearish, skeptical, that sort of thing. And the share price reacted, or the market reacted, quite positively to this news. And we can see it happened over 4 days. Share price increased quite a bit, from something like $3.10 all the way to $3.74. So just a breakdown of what I do. This is our personal strategies. So always have a buy and sell strategy. Told you about my buy strategy. Wait for consolidation period. Wait for a breakout. Wait for it to be high volume. Hopefully the breakout in share price corresponds to good financial news. That is the best sign. And always have a sell strategy. So whenever I buy into a company, I always have a sell strategy. So I always think, what would cause me to sell this company? And for example, with Treasury Wine, I bought it one day, and a few days later, it triggered my sell strategy criteria, and I sold out of it without hesitation. And follow that sell strategy to 100%. Don't hesitate. Don't think, oh, maybe I'll just wait this out. Follow that strategy as close as you can, 100% as you can. In these sort of situations, be very patient. Don't rush in and buy straight away just because the share price has fallen 26%. Don't just think, oh, it's cheaper now, I'm going to buy in. I've been waiting for this situation for a while. Just be patient. Share price will always give you signs of it turning around. Breakouts may never happen. That's a reason why you should be patient. So you could say, a few years ago, AMP, share price dropped 5%. Oh, I'm going to buy now. It's cheaper than it was. But then the share price kept dropping and dropping and dropping and dropping. I think it's been dropping ever since it IPO'd. Breakouts can always fail, just with Treasury Wine groups. And again, don't be hesitant to sell once that breakout fails. But those breakouts can run many, many years. And that's the whole point of this. So with Treasury Wine, my loss wasn't much. But with Costa Group, if the trend just continues for years and years, it could go all the way back up to $8, could go past $8, $12. So I could be looking at 100% gains, 200% gains, 300%, who knows? So just ride your winners as long as possible and sell out your losers like Treasury Wine, who failed the breakout. So that's all I got in this video. Again, I'm not a financial advisor. These are just my strategies. So I'm just trying to give you possible strategies you could use. I wouldn't follow my strategies ad verbatim. I think everyone should develop their own strategies because everyone has different risk portfolios. I'm more of a risk taker than being risk adverse. So find out what sort of risk portfolio you have and try to adapt your strategies to that risk portfolio. That's just my opinion. I'm not a financial advisor. If you do need financial advice, make sure you seek out a professional, qualified person, and maybe they can help you. That's all for today. Have a good day. Bye.